Good morning and welcome to Unusual Activity powered by FinancialJuice.com with George Avedon and Milton Marmonides. Thank you for joining us the 16th of December 2014. The markets do not fail us on excitement. It's nonstop news, nonstop information globally, uh, domestically. Lot going on, folks. So we'll jump right into the numbers this morning. ES futures, S&P 500 futures are lower by 10.25 at 1973.00. We talked about that 2000 number yesterday. It broke clearly, and now it's a resistance, and we'll discuss the technical analysis side of things in a few moments. We have oil, West Texas Intermediate crude, lower by $1.75 at 54.14. We did dip below $54 for a bit of time. We're back above clearly at $54.12 at the moment, and we have gold higher by $3.70 at 1211 and 30 cents. The dollar, the DXY, the dollar index versus 10 other currencies at $87. I'm sorry, 87.802. 87 point, I'm sorry, it's 87.773. The euro at 1.2540. That's 1.2540. It looks like the euro did bounce up from those support levels at 1.223. Area. And if you recall, that we did have a conversation with Yohei about a week and a half ago or so, discussing the euro support. So again, interesting to see how the euro responds here at 1.2540. Dollar index is 87.782. So let's dive into the nitty gritty here, folks. Yesterday's day proved to be a predecessor to certainly this morning. We saw a risk-on trade in the pre-market and opening rotation yesterday morning, and then literally right within the first half hour to hour, we began to see this precipitous decline immediately following the opening, and that continued to till about noon, to a level of about 1983 in the S&P 500. We maintained a range in the negative territory for the rest of the trading day. S&P 500 finished lower by 0.63% at 1989.63. Dow Jones Industrial Average finished lower as well, lower by 0.58% at 17,180.84. And this is something that Milton and I will talk about in a few minutes, but this has been probably the quietest near 900 point decline we've seen in years. It's rather astonishing, frankly. The Nasdaq at 4605.16, lower by 1.04%. So again, folks, what's on our minds, as always, we're keeping an eye on geopolitical events. We're keeping an eye on oil. We're keeping an eye on commodities. We're keeping an eye on rates, macroeconomic indicators that are coming out both globally and domestically. And folks, they have an effect on markets. We've seen this over and over again. When you have macroeconomic headlines, they do impact macro indices. So certainly, as we always talk about, responses to oil prices, what's interesting to us is it's every day that oil is lower. Oil is lower. We're seeing a consistent increase in the discussion of oil and what it's doing to individual countries, what it's doing to individual companies, big and small, both in the U.S. and abroad. And so that is something that we're keeping an eye on. Certainly, certainly of what's been in the news is the Russian ruble. Certainly, the central bank increased rates, and for a moment there, we had a spike, approximately 9% spike in the Russian ruble, that went back down again. Massive volatility. Certainly you'll see rate discussions on the part of the central bank, and this is something that we mentioned yesterday. When you're concerned about a currency, when you're concerned that a very steep decline in the currency, and you have companies, investors that are in that particular country, for example, in Russia. Russia will, in other countries of this ilk, and that are concerned about a depreciating currency, you always talk about capital controls. What kind of controls are in place on the part of the central bankers, the government, to limit the repatriation of funds coming out of Russia? And that's what we believe is going to into the picture a bit more here. So that's something that's we should keep an eye on, and we will as we progress into the open, which is approximately 25 minutes away in New York. Also, sinking oil prices. Clearly, crude oil currently at 54.69, excuse me, $54.67. So still under that 55 level we talked about yesterday, lower by $1.28 this morning. And certainly bounced off the lows there. We can we'll take a look at it from a technical perspective in a few minutes, but a rather impressive bounce from this morning of $53.60. It's about a point increase there, and we'll talk about that capitulation, this concept of capitulation, what you want to see out of that, and whether we can see that within the near term. Certainly, the FOMC meeting begins today. The announcement is tomorrow in the afternoon, and the conversation will considerable time be removed. And also, what's really not discussed out there is not a huge amount, but really, what's the Fed's vision on the global economy versus the U.S. economy? And that's something that's really important here, folks. As we listen for the FOMC meetings, will they mention the global economy? Will they mention the potential slowdown, the lower inflation expectations? That's something that we believe that analysts will also be looking at, verbiage, and certainly the statement from Yellen after the announcement tomorrow. We had ICSC comp store sales higher by 3%. Housing starts month over month for November were lower by 1.6%. Estimated was to be an increase of 3.10. We have the actual numbers are 1.03 million versus the expected 1.04. Prior was 1.05. I'm sorry, prior was 1.01. The Red Book was lower month over month at negative 1.20%. Previous was 1.3%. So we had the Red Book this morning, waiting for the 9:45 PMI manufacturing index announcement. 11:30 is the 4-week T-bill auction results, and of course we have the Baltic Dry index falling 0.8% to 838 points. And folks, the Baltic Dry Index is rather important here. This is a very rather leading indicator on how much is being shipped, raw materials, grains. So it's a very important index to watch, and this is why we report it on a daily basis. A brief overlook on the overview on the overnight markets. And then we'll jump into the technicals. with Milt. So in Asia, we had the Nikkei lower by 2.01%, Hang Seng lower by 1.55%, Shanghai higher by 2.31%. When I look at the Shanghai, just remember the recent volatility in that particular index. So numbers of higher than 1% seems to be the norm within that index. So that, again, that's rather important to watch. Excuse me. We have in Europe, we have the FTSE higher now by 0.39%, CAC in Paris lower by 0.8%, and the DAX lower by 0.22%. The IBEX in Spain is lower by 1.19%. So we did have a little bit of a pullback in the European on the European continent with respect to the indices. So we did a little bit lower than we were about 45-50 minutes ago in Europe. So what we'd like to do is let's dive into the technical side of things. And we mentioned the reason why we bring up technical is it's crucial to monitor not just the fundamental, which we bring you every morning, but really what does this mean for the specific levels, because everyone watches these levels. Milton, we had a really significant day yesterday, I thought, in the ES. We talk about it offline. We broke the 2,000 support level. What's your thought on this? How are you viewing the ES this morning?
Oh, George, let me just give you a quick rundown of what we mentioned yesterday. Then I'll go into the quick analysis today. We mentioned yesterday in the ES, the 2,000 number, if it was going to be broken, you can see continued downside. What happened? It broke. We had continued downside. Currently down 9 handles this morning at 1974. We will see what happens this morning after we go over the quick analysis of that. Another one I want to give a quick thing about was the oil. We're mentioning oil every single day. Stay away, stay away, stay away. What happens? Every single day, oil goes lower. We're down $1.59 this morning at 54.32. Excuse me. I want to make sure people understand that, ideally, oil, we want oil to base and have a nice reversal. But clearly that, in my opinion, may not be the situation we have here. We may have a situation here, George, where it could just have a vicious down open with a vicious rally and have that V-shaped bottom. Technically, that's not a quote-unquote healthy type move, but it can happen. So we can see that happen. We're watching every day. 55 number was our level on oil. It's right around there right now this morning. It broke it below it, but it's trading right, 50 cents lower this morning, right under that number. We're going to keep an eye on that level. I'll talk more about oil in a few minutes. Let me just jump on S&P ES real quick. The ES right now, we have a level right where we're watching is right here. 1975 pre-market is somewhat of a simple support level on the ES. Ideally, the 1950s number is that daily support. We will be watching that as an indicator of a possible somewhat short-term bottom in the markets. It's very difficult to get an ideal feel on the ES because it's a very difficult, instrument to use and understand. Technically, we had that rounding top that we mentioned weeks and weeks ago. It happened. It worked. It turned. 1950 will be an ideal level, but at this point, with such a big drop in such a short span, George, you can have any type of reversal in any day. So, as of now, technically, we got the 2,000 upside resistance to the 1950 support. It's a 50-point range in the ES. Keeping an eye on it. When we get a better feel and a better, mindset when the market opens, we can probably throw a better input into the room. But as of now, we have that 50-point handle. We're mentioning the 2,000 upside resistance and the 1950 support. Yes, George?
For what historically December as being a very tame month for volatility, this is turning out to be a rather interesting Rather interesting month, wouldn't you say? I mean, lots going on in oil, lots going on in the ES. So I think the traders are not going away on vacation anytime soon.
No, I agree. You also have to understand, a lot of people, we speak to a lot of people during the day, and many people just don't understand what really is going on in this market.
Yeah.
Typically, for years and years and years, the Christmas time is, it's dead. The markets are dead. Volatility is, anemic. Now it's a whole new story.
Tremendous.
It's a whole new thing, and people just do not know what is going on, what to do. People don't expect this to happen, so, like I said, tread tightly, and, be able to understand and hold what you have, love what you own right now, because honestly, at this point, we could wake up in the morning and who knows what could happen in Russia or Europe or Asia, and we can come into a disaster, or we can come into a joyous. Who really knows at this point, And if anyone tells you they do, I recommend not listening to them again, because clearly they have no idea. How many people bring into oil? How many people thought oil will never go to where it is today?
No doubt.
99% of the people out there thought this would never happen. Of course. But, they come out and say, oh, well, oil is going to go back to 80, 90. Why? Why is oil going to go back to 80, 90? Clearly, OPEC does not really care where oil is at this point. It's trading in the 50s. The 50s. Oil was at 100 3 weeks ago. It's trading in the 50s. Countries are getting destroyed, and no one cares. No one mentions, oh, it's going to go back to 80. We'll see if it goes back to 80 by the end of this year. If it does, great job. Let's see how much, let's see what really happens in the next 3 to 6 months if oil stabilizes in the 50s. Let's see what countries will be able to sustain this level. Let's see what, companies could sustain oil at 50s. Who knows? But technically, it could be a somewhat of a level to take a peek at. We've mentioned 55 to 50s. We've mentioned that for the past few weeks it could go that level. It finally did it. Right now, it could be something to keep a close eye on. We're looking for a base to form, ideally. But you may have that V-shaped, vicious reversal on a day which would be capitulation. You need a down day with a vicious reversal on the volume to possibly say, you know what, guys, this may be our short-term bottom. Hasn't happened yet. We're waiting every single day. And what we say every day, for the past 2 weeks, do not be a hero. You're not bigger than the oil market. You're not smarter than the oil market. They will tear you down and throw you away like it's nothing. So stay away until you believe, until you see some stabilization in this market. Until that happens, good luck. Well, that's all we can say at this point. We've been mentioning for weeks, stay away. When oil was in the 70s and 80s, we've been saying it. In the 50s right now, which the number that we've mentioned could go to, finally is in that range. Maybe it's time to open up your eyes and take a peek and see what we can find here. Let me jump on the VIX. The VIX, it's currently at 2042. We will see where it opens after the market. Opens. The resistance is between 22 and 23 to the upside. Support right now is at that 18 number. It's trying to build some support around 18, 16 to 18 on the support side. The VIX to the upside, 22, 23. We're watching those levels, keeping an eye on that, and see what happens regarding the VIX. Lastly, we're jumping out to gold. It's that 1,200 number. They broke it yesterday. They contained it. They brought it back above 1,200. That's the number that it's been basing around. It's going to base around 1,200. We've been mentioning that for days and days. Ideally, for the bull case scenario, you want to see a building of a base here and a move back above 1,250. The bearish scenario will be the complete opposite. A break here with volume hitting that 1150 number. Right now, it's a toss-up. It's trying to stabilize on 1,200 number. Once that 1,200 number is either broken or broken to the upper downside, we will get a much larger continuation of that move. So right now, it's 1,200. Keeping an eye on that level and watching for a break either to the down or upside. George?
Thank you, Milt. So folks, as we always say, it's not just technical, it's not just fundamental. It's really understanding the entire process that goes into this notion of trading and investing and really understanding what the what a good trader does on a daily basis to prepare themselves for the day, for the week, for the month, what have you. Um, however you begin to uh, align yourself with the market in terms of your directional plays and so forth. So it's really a great idea, a really great idea. Certainly due diligence. We always talk about that, but really this notion of understanding what the fundamentals mean for specific markets, whether you're an FX trader, commodities, energy, regular equities, maybe equity derivatives options, but really understand the fundamentals and understand the technicals, because technical levels are really crucial. Even if you choose not to be a huge technical analysis, or maybe on the other side a huge fundamental trader, but really need to understand what everything means. You may not incorporate everything into your strategy, but at least understand how something impacts. What's the ramification of a technical level being broken at the same time if there's capital controls on something, or maybe there's a decrease in production? What does all that mean? What it could mean? And really set something for yourself up with respect to what's called scenario planning. So if A, B, and C happens, this is how I'm going to position my trading. If D, E, and F happens, this is how I'm going to do that. That's always a good idea to do. So let's get into a little bit. We talked about the specific technical levels on the major on oil and ES, S&P futures, the VIX. Let's dive into commodities, energy, and raw materials this morning. So we have oil. We talked about oil. CL is rather volatile this morning. Certainly we jumped off, we bounced off from 53.6, stabilized for a few minutes at that 54 level, popped up to 74.75, and now we're back up to 54.17. So clearly folks, lots of opinions on oil, where it should be, and this is where you're getting that volatility. It's not what's commonly referred to as a herd mentality, where either everybody's buying or selling. When you have this type of volatility, there's clearly a difference of opinion. So that's something that we can really monitor. So let's jump into also the distillates as well. Excuse me, folks. On the distillates, we have natural gas lower by 0.0521 at 1.5239. Natural gas lower by 0.056 at 3.663. Heating oil lower as well this morning at 0.0482 at 1.9535. And just a quick, as we're talking about oil and distillates, two things that are just coming. We wanted anecdotally in the Northeast, we've had oddly enough, a rather warmer December. And usually the Northeast is one of the larger consumers of heating oil, natural gas. So just a little bit of anecdotal there. Also, we just had picked up S&P commenting that U.S. shale drilling cut likely if West Texas Intermediate crude stays below $75 per barrel. So that's something that we're going to monitor on how we can how these types of headlines may affect oil. So we as we're going through this, we're going to be joined by Yohei Elam, from Forex Crunch. So, Yohei, welcome. And we're just gonna run through a couple more numbers here, and then we'll bring you right in. Also, we have gold at $1,211.20, higher by $3.40. Silver lower by 0.243, lower by 24 cents at $16.32. Platinum lower by $2 at 12.13 even, and that's and cocoa we have higher by $23 at 28.96. We'll do a quick recap of where we are on the rate environment. We have the 5-year 1.498, which is quite a bit lower than we were about a week or two ago. Well, we're right up in that 1.6264 yield, 1.62, 1.64 yield. So that's a little bit of an improvement. We've and also that we have the 10-year at 2.048. We have the 30-year at 2.689. So clearly lower yield here, folks. And we have, even if you compare the 10-year and the 30-year compared to a month ago, a considerable difference in these treasuries. So we've mentioned this before, a possible flattening of the yield curve, not flattening, but less steep, if you will. Even if you take a look at a year ago, if you take a look at even a month ago, and certainly looking at the 2-year, we're looking at 0.54%, which is just in line. We're just about in line where we were about a month ago, higher than we were about a year ago at 0.33. So a little bit of an increase in yield on the treasuries. What we'd like to do, maybe, if Yohei, would you like to let's welcome Yohei, and how are you?
Great, thanks. Happy to see markets moving.
Great, thanks for joining us this morning. We're in no deficit of a little bit of craziness in the market recently. What's your give us your what are you seeing out there? What's of interest to you within the last few days to a week or so?
Well, I focus on currencies, so what I've seen today is an interesting divergence between major currencies such as the euro, pound, and the yen, which have strengthened against the dollar, and commodity currencies, especially the loonie, the Canadian dollar, which are sort of pressured down by the dollar. So that's the interesting take of this risk-off environment, of the collapse in oil prices, the search for quality. That's my focus in these days. Of course, oil is the main thing, but yeah. I don't talk much about oil, so.
We brought up this notion, and I know you're primarily in FX, and but we brought up this notion is certainly the oil is certainly dollar denominated, gold is dollar denominated, so it's. Although it's not always, we don't see a kind of a inverse relationship where if the dollar goes higher and oil goes lower, but there is some correlation there.
Yeah.
What are you hearing anything specific? I know you're FX, but what are you hearing out there with respect to oil? I mean, what's the conversation like? Globally, as folks are looking at oil in these rather low prices, what's your take on that?
Well, of course, I guess you've talked about this before. It's good for importing countries and bad for exporting countries. But specifically, if we look at in currencies, it's sort of, there was a story of it's bad for the euro because it means a bigger danger of deflation and more action from the ECB, and weaker euro, but good for the U.S. I think we were talking about this last time.
Yes.
It leaves more money in the pockets of consumers.
That's right.
Well, that's still true, but with such a rapid fall in the price of oil, it's going to hurt the U.S. economy in another way. I mean, perhaps most of the economy is going to enjoy lower prices, but producers of oil, especially the new projects over there in Kansas, Oklahoma, are going to suffer, and people are going to be laid off. And part of the growth that we've seen in recent years in the United States has been related to oil. So I think it's going to make the decision for the Fed tomorrow much more complicated than it was beforehand.
So, I think you bring up some good points, and this is, it's interesting. I have a feeling that, we're being listened to by, other folks as well, because, we'll bring up a concept a few weeks ago, and sometimes it makes them, major headlines. But, the reality is, you're right. It's helping the consumer, right? And that's globally, whether it's in Europe or in the U.S., wherever it is, it's a boon to the consumer pocket, right? But in longer term, this morning we just had S&P just commented that U.S. shale drilling cut likely if crude stays below $75. So clearly that $75 mark is rather important. We talked about how it may have an impact on lending with respect to how these specifically smaller companies function, because they function on debt, right? And if they can't repay that, if they can, then that's the forgive the zero hedging thought process here, but it could be a bit detrimental here in the longer term, and I think you're absolutely right on that.
Yeah.
Yeah. Now we're waiting for, you mentioned the Fed. What would be in line with what's expected with the Fed? What's your thought on that? I know you spent a lot of time on researching and doing a lot of work on the ECB and the Fed and so forth. What's your take on that? What can we expect out of this meeting tomorrow?
Well, the Fed's first and foremost job is to talk about the U.S. economy, so deal with the U.S. economy. So the situation is improving. We've seen a superb non-farm payrolls report, good jobs report, jobless claims are all right. Inflation is still okay, core inflation at 1.8%. So this should all lead the Fed to removing this phrase considerable time and setting the path for a rate hike in spring or summer of 2015. However, I think they are aware of the role as sort of the biggest and most important central bank of the world, and the stability of the financial system. I mean, suffering in other countries could eventually come back to the U.S., so I think they'll maintain this line of caution. Some analysts talked about changing it to wording about patience regarding the rates. I don't think we'll see that kind of wording, but they'll sort of repeat the message, which we sometimes forget, that everything is data dependent. Currently, there is scope for a rate hike during 2015, but everything depends on the evolution of the economy, and so that's the kind of message I expect. And given the recent slide in the dollar against the euro, yen, and the pound, I think the greenback could rebound against these three.
Yeah, no, I think you bring up some good points, Yohei. Our thought process is either going to remove the considerable time phrase, and they're gonna substitute it with sometime in the future. But what would be a shocker from this meeting? I know we're not anticipating a shocker in this meeting. I think they just it feels as though they want to finish out the year, maybe set the expectation for 2015, at least going forward. But what would be a little bit of surprise to you? Do you think they'll mention the global economy in their statements, or at least in the press conference?
I think they're a bit afraid of their own shadow. We've seen that last time. So we've seen in the minutes that they wanted to talk about the slowdown in Europe, Japan, and China, but they didn't want to scare off markets. So it came up only in the minutes and not in the statement. So I think they'll mention oil prices. I think it just cannot be ignored. It's a spectacular plunge. It would be just sort of defiant from them not to mention that and the impact on at least the U.S. economy. But I think Yellen in her press conference will try to send the message that we're in control. Everything's all right. Don't worry. Trust us. We'll raise rates when we'll be ready, and sending a message that when rates will rise, it'll actually be a good thing for the U.S. economy, because it means that the dovish Fed acknowledges that something good is going on with the U.S. economy, and only then rates could rise. It wouldn't be a shocker to the market. A shocker tomorrow would be either they would hint of an upcoming rate hike, saying something like the conditions are going to be ripe quite soon for a rate hike. That would be, of course, dollar very, very positive for the dollar, or something like recent slowdown in the global economy means that we could push back rate hikes or perhaps renew the QE program. I don't think either of these scenarios is feasible. I think we'll continue seeing sort of confidence from Yellen towards rate hike in 2015. She doesn't like to rock the boat too much, and
absolutely. What would you say would be? I want to phrase this the right way here. So, when we begin raising rates, right? Are you anticipating? Like I remember back in Greenspan, we were trading during when Greenspan was around, and one of the things that his Fed was absolutely when they set on raising rates, it was literally every meeting, every 6 weeks, minus the breaks. I mean, this was a consistent increase in rates. Is this something that, considering that what's going on globally, right? Our thinking is that, maybe if they raise rates, it seems they're on the dovish side overall. Clearly, what are you going to see when? What do you think we'll see when they actually start raising rates? Is this going to be? I think we have a minor technical issue here, so just bear with us with Yohei as we're waiting for Yohei to come back. We did have a few pieces of news come through. Through the markets, I think we have Yohei coming back. So when he's set up, he'll let us know. But on the VIX, folks, as we're waiting for Yohei, on the VIX, we're showing some very interesting prints on the VIX here. The VIX currently at 2182, so we're getting a little bit of volatility there. In the VIX. Also, on Walmart, we're having a few things come through in Walmart. Pennsylvania Supreme Court upheld judgment from 2007 case and sees 6-cent charges on WMT. WMT, we currently at $83.98. Yohei, glad to have you back. It's a beauty of technology. But are you anticipating with rates? Let's say July. Let's throw a time out there. July 2015, first rate hike. Are we gonna see a consistent rate hike through every meeting, or are there just gonna be kind of a let's do it and see what happens type of mentality?
I think, given the decision with the taper, I think we'll have very calculated wait before the first rate hike. Everybody knows it's the historic event, and the Fed would want to make it in the best possible moment. I think that because of that, because of the press conference, we might see it already in June when the Fed has a press conference, and then I think we'll see a consistent path of rate hikes. I think it'll reach 1%, and then we could see a pause. Eventually, if the economy is doing well, it could continue rising, maybe reaching 4%. I don't think it'll reach pre-crisis levels. But anyway, once the Fed starts hiking, I think we'll see some 3-4 rate hikes in a row without press conferences, similar to the taper. The Fed waited a very, very long time before the taper process in December 2013, and then it never stopped the taper. Of course, if some kind of disaster happens, or if we see inflation, wages especially, jump up, we might see a different scenario. But my base case scenario is rate hikes up to 1% in a row, and then we'll see. That'll be relatively far away in the future.
Yeah, sure. And again, and I know you're on the FX side. If we're anticipating rate hikes, this is the question that Milton and I always have for our guests, and when you look at the rate hikes, the 10-year is just the yield is just going lower and lower and lower and lower. What's the thought process behind that? How would you rationalize if indeed the market is assuming a rate hike in 2015? Why does the 10-year just meander a bit lower every so often, and it's right between that 2% to 2.3%? What's your thought process on that? If any thoughts on that?
Yeah, well, also in the U.S. and other places, there's fear of deflation. The countries are trying to move deflation to one another, especially wages. We've seen that in the U.S. In Europe, of course, where unemployment is high. In the UK, in Japan, where the government is trying to encourage companies to raise wages. And for me, wages is sort of the source of core inflation. And when wages aren't rising, and on the other hand, oil prices are falling, that means that also headline inflation is falling. Then if you have 2% yield, it's not too shabby, as they say. So, and together with the flight to quality, we've seen the German 10-year bonds fall to 0.6%. They're going Japanese. I still am optimistic about the U.S. I still think that apart from some oil companies, probably the worst ones going bankrupt, and some layoffs, the larger U.S. economy, as I see it, is doing quite well. And regarding wages, many companies give wage hikes, give a salary raise at the beginning of the year. There's sort of these annual conversations. So I think we'll begin seeing it in a more pronounced manner in January, February. It'll appear in the average hourly earnings component of the non-farm payrolls report. We've already seen something. It may still be a one-off in the November report. So I'm optimistic, and once it'll be seen over and over again, I think the 10-year yield will also react and tick up, and money will move into other places.
Sure. No, I absolutely. I mean, I think our thought process is very similar. It is a kind of a bastion of last resort, if you will. Let's get into, if you don't mind. I know you're big in FX. Let's take a look at the euro. I have the on the chart there. I have the E-mini euro FX future, the March 15 E7. So we're currently at 1.2523. I know when we spoke last, the euro was in a slightly worse situation. We were around that 123 level, 123.00, and we were actually discussing whether or not it was feasible to hit that 1.2000 level. Certainly we're waiting on the ECB in January, correct? To see what's coming out of Draghi, and again, we discussed this constant political wrangling, versus the ECB philosophy versus the German economic philosophy with respect to fiscal responsibility. Where are you seeing the euro now? We're currently at 1.2526. Take us through a little bit of the swing trader mentality, and maybe even longer type thought process. What are you thinking about the euro here?
Well, today's move up has quite a few reasons. We had data coming out of Germany. The zoo economic sentiment, business sentiment, just jumped much more than expected to almost 35 points. And also manufacturing PMI in Germany rose back to growth territory. So for those traders looking at the euro as a proxy of Germany, that was, of course, good news. Also, what we've talked about before regarding the US dollar, that the fall in the price of oil might also have negative effects on the US economy. I think this is also causing some kind of dollar sell-off. But I believe that these doubts will be taken off by the Fed tomorrow. There's another reason, a few more reasons providing a bid for the euro. We have the Swiss National Bank. They have a peg of euro Swiss under a floor of 120. Last time I looked, it was 120.08, and I believe that at these is very, very close levels to the peg. The Swiss National Bank is basically on the bid on euros. So all these things support the euro, at least now. I believe that together with the Fed, with deflation in Europe, and we'll have updated inflation numbers for November from Europe, and later we'll have probably really deflationary numbers for December, early in January, and with the Fed continuing its steady path. I still believe 120 is feasible. It just takes more time, and it's important to remember one thing that isn't news regarding the euro, and that's the trade balance. Germany's exports to China and to other places just provide the Eurozone a positive trade balance, current account surplus, and when nothing happens, the euro is basically bid. So we need, for the euro to fall, we need bad news in Europe and good news in the US. We got plenty of that in the last few months, but for another leg lower, we would need probably more data.
Got it. And as we were speaking, the manufacturing PMI for December preliminary came out at 53.7, expected with 55.2. Previous was 54.8, so a little bit lower on that manufacturing purchasers managers index. Looks like a December preliminary. So again, we'll see how.
Yeah, that's market.
Yeah, it looks like we're getting a little bit of. Let's take a quick look at the ES. Bear with us here. Yeah, we're getting a little bit of lift in the ES, currently 1978. Remember, we were a little bit lower by about a little bit over 10 in pre-market, so we're getting a little bit of lift here on that PMI number. So if we're going into 2015, let's have a brief kind of thought going into 2015. Just folks that are listening to us, folks that are kind of preparing their portfolios for 2015 with respect to effects, with respect to global economy. So we're looking for the Fed, certainly tomorrow's announcement. We're looking at if we see numbers consistent with deflationary type, I'll say deflationary. I know it's the lower inflation, but I call it deflation. Conversation between the ECB and Germany. What else are you looking for in 2015 that is on your radar as we prepare for that year?
Well, looking at the world's #2 economy, China, I think we'll see more evidence of a slowdown there. part because they just can't grow so fast, part because it's engineered by the government. So we're going to see slower growth rates there, and in Forex, the best way to play that is the Australian dollar, of course. The central bank there wants to see Aussie dollar at 75 cents, and I think Aussie dollar will continue grinding lower throughout the year. Regarding Canadian dollar oil prices, I think this will eventually self-correct. I said that last time, and since then we had a much bigger plunge. So maybe it'll still get worse for oil prices before it gets better. But specifically for Canada, an oil exporter, the loonie suffered quite a fall, and I think the situation in Canada is better than what we see on Forex. I mean, the U.S. demand especially is good, unemployment rate is low, so I believe we'll see a big improvement in the Canadian dollar in 2015. And regarding euro dollar, I think it'll be sort of a tale of two different tales. I think we'll see euro dollar falling in the first half, but eventually the weaker euro, the lower oil prices, the stimulus from the ECB will all help Europe recover, and I think in the second half we'll see euro dollar climbing back up.
Got it. No, that's great. And we are seeing oil stabilize this morning a little bit in early morning trading here at 54 to 54.50 level. And you mentioned this before, and we always talk about this: the fact that it's basically oil being this low, gasoline being this low. It's not just a boon to the consumer, but really from an inflationary perspective. And you mentioned this last time, was the fact that the numbers from Europe, inflationary numbers from Europe last time, didn't even consider the oil plunge. So certainly oil being even lower than it was when we last spoke certainly contributes to that as well, I think. So, but again, it's a double-edged sword to every move, correct? And that's something that we'll continue to monitor very closely.
Right.
Yeah, absolutely. So as we wind down, let's take a look at where we are. S&P futures are lower this morning at we're at negative 2.5 at 1981.00. Crude oil, we're lower by $1.32 at $54.62. 10-year at 2.061. The DXY, the dollar index versus the 10 currencies, at 87.930, and the euro at 1.2515. Gold is more or less flat at 1207.20. We're looking at that 1200 support level. Yohei, thank you so much for joining us. It's always a pleasure to have you on. We hope you come back. Always a great way to add color, not just to the conversation, but to how traders really approach their portfolios, and really keeping in mind both the fundamental and the technical analysis. And thank you for coming in today.
Okay, my pleasure.
Thank you. So folks, thank you for joining us this morning. This has been Unusual Activity, powered by Financial Juice, with George Avedon and Milton Marmonides, with our host Yohei Elam from ForexCrunch.com. We wish you a great day and good hunting. Thank you for joining us, folks.